Hey everyone, today we're going to go over how these self-funded or level-funded health insurance policies work compared to your traditional fully insured programs. So let's dive in. So let's first talk about how fully insured works. How fully insured works is if you're a Horizon client, AmeriHealth, United Healthcare, along with a few other carriers, your premiums are not dependent on your health. They're based on your age. So if you're 50 years old and your rate is $700, you're paying that $700 whether you are sick or you are healthy. How it works is these carriers, they insure thousands of companies and they take in premiums from all these different companies, whether you own a grocery store, whether you own a construction business, whether you own a trucking company, a pharmaceutical company, whatever it might be. They're taking in all these premiums and then they're paying out claims. So let's take, for example, that the insurance company brings in $1 million of premiums, but they spend 1.1 million in claims. Well, the next year they're going to give everyone roughly, let's say, a 10% increase. Now, whether you use the insurance or didn't use the insurance, you're under their book of business, so regardless, you're getting that 10% increase. So if you own, let's say, this trucking company and you know that your employees didn't use the insurance and you're getting your premium increased by 10%, you're going to be frustrated. So what do? Well, you could look at these level funded programs where their premium is going to be based on your health compared to being in just these insurance companies' total block of business, right? So again, everyone on here, all these different businesses, they're going to get that 10% increase the following year, whether they use the insurance or didn't. So where a lot of small business and mid-sized companies have been going to are these level funded or self-funded programs. So let me explain how it works. If, depending on your group size, you either have to answer medical questionnaires or just provide a census. It's a pretty easy process, but once you do go through the underwriting process, they come back to you and they say, hey, these are your rates. So I'm going to dive in. I'm comparing an Aetna level funded option versus Horizon and United Healthcare. So we kept the benefits pretty similar, and I'm just going to go down to the bottom line in terms of the cost. So if we're looking at the cost here at the bottom, this first option being Aetna, the premium is $17.53 a month for 3 individuals. Had they stayed with Blue Cross Blue Shield, their premium would be a little over $2,000. And if they were with United Healthcare, it'd be, again, a little over $2,000. So we kept benefits the same, but now we're saving close to $3,000 to $4,000 a year in premium, which is pretty substantial for this size group. Now, of course, if we were a larger group, right, we can just multiply those savings. So this is a way for this company to have their premiums be based off of them as opposed to these insurance carriers' total block of business. Now, we're showing with Aetna, but United Healthcare, Cigna, Blue Cross Blue Shield, there's a lot of different other, Allstate, there's a lot of different self-insured options out there. What we do and how to, again, qualify to get the quote for these options is to, if you're under 10 employees, to fill out a medical questionnaire. It's a 2 or 3 page questionnaire. It's not hard, but basically the insurance company is evaluating your group's risk over the next year. If they feel like that, hey, you know what, this is a healthy group or a mediocre healthy group, and we think that, they're a good risk, they'll give us an offer, such as this company, they got an offer for $17.53. But maybe it comes back one time and it's $2,300. Well, then we know, hey, we're going to stay with United Healthcare, we're going to stay with Blue Cross Blue Shield. But again, those rates that we're getting from Blue Cross Blue Shield or from United Healthcare, the rates are the rates. Whether you're an employee there or whether you've been a customer of theirs for 10 plus years or 1 year, the rate is the rate. There's no changing it. And again, there's no pre-existing condition, so at any point you can just jump onto those plans through your employer and not have any issues. So what we traditionally do is we have the group, if they are under 10 employees, complete that medical questionnaire, and we'll share it amongst a few different carriers and see which level funded option is going to be the best for our client. And then again, we'll compare the benefits and the savings, and we'll figure out if it makes sense going forward. Now, like I mentioned, with Horizon, with United Healthcare, the rates are the rates. So for this group, they would be paying $2,002 with Horizon per month, whether they were sick, healthy, or anywhere in between, right? Horizon's basically, again, taking that premium in. There's going to be times where they pay out claims to this group or to another group, but it all evens out for them in the end. So what this group did is they had the premiums be based off of their health. So they're going now here with this plan for $17.53. But how does it all work? So how level funded plans work is basically there's a few different items here. Of that 1753 that we see here at the bottom, $780 of it per month is going into a claims account. That claims account over the course of the year adds up to that total number at the top, that 9370. So over the 12 months that this group is paying this 1753, 9300 is being put to the side to pay for their claims. Now they're going to go to the doctor, right? They're going to get a prescription, and every time that the insurance company has to pay out a claim, it's coming from that 9370. So for example, if I'm one of these employees and I go to the doctor, I believe for this plan my copay was $40. So I go to the doctor, I pay my $40 copay just like I would with any of the older traditional plans. I pay the $40, but we know that doctor's still getting more from the insurance company. So that insurance company is then writing a check, let's say for $60, $70, whatever the number is, from that $93.70 number. And so over time, that $93.70 is being depleted with each and every claim. Now, what happens when that $93.70 is depleted, right? And we run out, or if we have $1 million worth of claims. Well, how these level funded or self-insured options work is of this 1753, $780 of it is going towards the claims account, but this 463 here in the middle, that's going to your stop loss premium. And what that's doing is it's buying insurance so that once 9370 is depleted, the insurance company comes in and picks up everything above and beyond that. So what this does is it reduces our risk, right? If we were traditionally self-insured, we're going to pay all the claims out of our pocket. But here, we're setting aside money throughout the year to pay for our claims. But in the event that there is a giant claim, someone has heart surgery, it's again $1 million, we're not stuck holding the bag. The insurance company is coming in and purchasing that stop loss. That other $508, that's going toward the administration of the plan. Again, they're paying for the network, right? So in this situation, it's with Aetna. So there's a cost to that. So for here, how these self-insured, these level funded plans benefit small groups or mid-sized groups is if claims are on the relatively low side, if we know we're a healthy group, there's a chance that of this claims money, we actually could get money back. Now, this specific contract was a 50% return, meaning that if at the end of the year, this group, this ABC company, if there is money left over in that 9370, they get half back. So let's pretend that over the course of the next year, there's no claims. Well, I know that I can get back close to $4,000 to $5,000 in a check. Now, of course, there might be some claims, so things are going to, again, that 9370 is going to get chiseled down, and maybe there is $6,000 left. Well, I'm getting a check back for $3,000, and now because Aetna knows that I'm a good risk, next year's renewal is going to be very low because, again, they're looking at me saying, hey, you didn't have many claims. The group didn't have many claims, so here's a 0% increase or here's a 2% increase. Whereas with United Healthcare, Blue Cross, those fully insured options that I was mentioning before, you're getting that 10% increase whether you use the insurance or didn't, right? Because again, you're a part of their book of business. Here, your rates are dependent upon your group. So ABC company, your rates are going to be based off the employees and their claim experience within the group. Now, again, Jeff, what happens if we blow through that 9370 and we have $1 million worth of claims? Well, again, stop loss is kicking in, so we're not there holding the bag, right? It's going to be like traditional insurance. However, at renewal, you're probably going to get a large increase. And if that is the case, they come to you and they say, hey, you know what, we have to hit you with a 30% increase. Well, if that's the case, then we're basically going to go back to Blue Cross Blue Shield, United Healthcare, some of these other fully insured options and see if it makes sense to go back to them. Because again, those rates are just dependent on age. It has nothing to do with where we're coming from, our pre-existing conditions, all that's out the window. So in the event that there is something that comes up, I know that I can always pivot back and go back to Blue Cross Blue Shield. But for our client here, we know that, hey, for the next year, we're going to save close to $3,000 in premium. And if the insurance company is right and they think that you guys are going to have relatively low claims, you're going to get money back. And next year, your renewal is going to be on the lower side. Now, again, this is really good for either healthier groups or mediocre healthy. I don't want you to think that, hey, I need to have, track athletes working for my business or anything like that. It's one of those things where it's always worth to kick the tires. So if you're with United Healthcare, you're with Blue Cross Blue Shield, and nothing against them, we have many clients with those programs. However, it's always worth to kick the tires because if we can save a group a good amount of money, it's an option. But if we fill out the questionnaires and Aetna, Cigna, whatever company comes back and they say, hey, you know what, you're not healthy enough. Hey, we did our due diligence. We know that we're going to stick with Horizon or with whatever option that we have at the moment for the next year. And then next year we can, again, kick the tires. But I would hate for any company out there to be one of those healthier groups and to go a few years paying into these fully insured options when they're just throwing money out the window, right? So if this is something that you have questions on or you're interested in, just reach out to us. But we do believe that this, is a good option for those, healthier groups, whether you're a 2-person company all the way upwards to 50. So obviously if I'm a 50-person company, the savings here would just be that much more. So we hope this was helpful. If you have any questions regarding how these level funded or self-funded options work compared to the fully insured options, please reach out. Thank you.